with Meagan Phelps, CFP, founder, Empress Investment Group. Meagan, thank you so much for being with us. So we see the volatility. Markets are under pressure. Each time I look up at the board, we're still here near these session lows. People are concerned because, you know, basically this year, 2022, has been tough. What are the clients asking, and what do you tell them?
What we're telling people is that you're a long-term investor. You need to focus on your written financial plan, focus on your time horizon, risk tolerance, what your income needs are, and of course, stay the course.
Yeah, you know, I see sometimes some people are concerned whether or not they can even retire. Are you hearing that from certain folks? I mean, what percentage of folks are retiring at 60, 65, 70? Have you noticed that changing at all? I mean, I'm not asking you for, you know, real stats. I'm not expecting you to know the actual stats, but are you finding trends that maybe people are squeezing out a few more years, or the opposite with COVID, they jumped out?
Definitely seeing a trend towards early retirement with this great resignation as well. Retirement is top of everyone's mind. One idea that we have to continually remind people about is these misconceptions that I think people play into when it comes to retirement. If they want to retire early, they definitely don't want their only plan to be deferring taxes into retirement accounts that they won't have access to until they're 59 and a half.
So what about the cash that they have? I mean, some of the mistakes they might make, and what do you advise them?
Right. So we find that there's really three primary misconceptions with retirees that we have to reteach people on to make sure that it's truly in alignment with what their objectives are. We hear this advice so frequently that unfortunately people kind of follow it blindly. The first is, as I said, saving into those tax deferred accounts. The problem with that is don't have access early for retirement. In addition to that, you're taxed at whatever future tax rates are. So that's a concern. Moreover, those accounts, if you are good at savings, you oftentimes develop large sums of money that you need to take required minimum distributions out on at age 72. And a lot of our clients, what we're seeing is they've overfunded those types of retirement vehicles, and they don't need as much cash as they've actually anticipated. And they're paying taxes on income they don't necessarily want. The other problem with these types of accounts is that when you pass them to beneficiaries, if those beneficiaries are in high income tax brackets, you can actually push them into the highest income tax bracket. So it's not very tax efficient. So what we teach people is making sure you're funding investment accounts that are more favorable from a tax standpoint on an annualized basis, get a step up when they pass to beneficiaries. Also focusing on the ability to fund Roth IRAs if you're eligible, or Roth 401ks for growth that's going to be tax deferred, of course, and then income that's tax free. You asked about
quickly. Yeah, I just wanted you to quickly explain what a Roth IRA is, so just so people, in case somebody didn't know what it was.
Roth IRA is an investment vehicle that you fund post-tax, and distributions come out tax exempt so long as you follow the rules. We really advocate for people, if you're eligible based on income limitations, to examine funding that type of account, because we don't know where tax rates are going down the way. We anticipate they'll actually go up. I think it's another misconception to think that you're going to be in a lower income tax bracket down the road. And if you have a Roth 401k, you actually can put in significantly more than a Roth IRA. So be sure to ask your employers if that's an option, and you could even fund a hybrid. You could do 50% pre-tax, 50% post-tax.
Yeah, and you know, ironically, and not that one has anything to do with the other, I know that you like, you know, healthcare, healthcare, consumer staples, and utilities, which today we're seeing healthcare and utilities down, but you know, those are generally more of a hedge play, right? That's why you like these defensive sectors?
We do. I mean, most of our clients, they're retirees or they're near retirement. They value principal protection over being opportunistic. Of course, there's opportunity in the market, right? You just want to be focused on companies that provide real products and services have growth and share in that profitability with their shareholders. There's opportunity, but again, for most of our retirees, erring on the side of caution, especially during these volatile times. We have rising rates, we have raging inflation, geopolitical tension. One of the things that we continually remind our clients of if they're nervous is that over the past 60 plus years, we've looked at geopolitical events, and 3 months after the onset, the S&P 500 is typically trading is trading higher. 12 months later, 80% of the time, the S&P 500 is actually trading higher. Right now, we're 5 to 6 weeks into the war, and we are higher on the S&P, at least as of Friday. We'll see where things go today. But the reality is we want to be realistic, but we also want to be optimistic, and our investors are mostly long-term.
Yeah, it's wonderful to see you, Meagan. Thank you so much for all these details on the best way to attack retirement and be fully prepared. Meagan Phelps, CFP, founder of Impress Investment Group. Thank you.